You've got $100,000 saved up. Pick the wrong fund, and you could miss $1.8 million. So, Fidelity or Vanguard? Most people just guess. Don't guess. I'll show you the simple rule that protects your money and your time. I'll show you the funds side by side, the real costs, how they follow the market, how they pay and reinvest dividends, and how tiny gaps become big over 30 years. This is clear and simple. You'll leave with one rule you can use today. Here's the simple idea. What you keep is what you earn, minus what you pay. Think of your money like a bucket. Most people only look at the water going in. Pros look for leaks. The leaks are fees, how closely the fund follows the index, how fast dividends are put back to work, and any account charges. Tiny drips, big loss over time. Why this matters? Small fees are not a one-time charge. They're like a yearly subscription taken from your account every single year while your balance is growing. On $100,000 over 30 years, 0.03% versus 0.015% isn't just $15. That $15 comes out again next year on a bigger balance and again the year after that. The gap keeps compounding. If two funds grow the same before fees, the cheaper one keeps more. Those extra dollars earn money too. Think snowball. Small at first, bigger over time. Low costs help it roll your way. High costs slow it down. Here's what you should pay attention to, and I'll put it as simple as possible for you guys. Expense ratio, the fund's yearly price tag, lower is better. FXAIX and FSKX cost 0.015%. VFIAX and VTSAX cost 0.04%. Tracking, how closely the fund matches the index it follows. Closer match equals better. Dividends, cash the fund pays out. Make sure they're set to reinvest so they buy more shares automatically. Account fees, avoid them. With Vanguard, turn on paperless to skip the $25 fee. Reinvestment timing. The faster money gets put back to work, the more it can compound over decades. How it plays out. Two funds that look the same can still finish with different totals. If one gets dividends back to work faster and trades less, it can end up 1 to 3% higher overall after many years. That's 1 to 3% total, not per year. On $100,000, that's still real money. Here's the trap, your behavior. The more pieces you have, the more you'll fiddle. Fiddling hurts compounding. Use automation. Turn on paperless to avoid fees. Turn on auto reinvest so dividends buy more shares. Set automatic contributions so cash never sits. Quick check-in. Are your dividends set to reinvest? If not, turn that on so payouts automatically buy more shares. With the basics clear, let's put the funds head to head. We'll start with the S&P 500. Small differences on paper can mean big differences in your money over time. Ready? Why start here? The S&P 500 is the main building block for a lot of investors. If you choose well here, most of your money benefits. If you choose poorly, that mistake spreads across your whole plan. What we're comparing, Fidelity's FXAIX with a 0.015% fee versus Vanguard's VFIAX with a 0.04% fee. Both follow the same list of 500 big US companies. They hold almost the same stocks. Dividends, the cash these companies pay, are about 1% to 1.2% a year. It's easy to think lower fee automatically wins. Not always. How closely a fund matches the index tracking and how quickly it reinvests dividends can make up for a small fee difference. Those small process details add up over time. Here's the setup. Take $100,000, turn on dividend reinvestment. Hold it for 30 years, no trading, no guessing the market, just let it grow. Because both funds follow the same index, the results are usually close. But small things, owning slightly different slices of the index, holding a bit more cash, or getting dividends reinvested faster, can still move the final total. Quick reminder before we look at numbers, this is a simple model using today's fees and how the funds have tracked in the past. The future is unknown, but the mechanics are solid. Over long stretches, it's common to see a total difference of about 1 to 3% after decades. That's total, not per year. Depending on the period, sometimes Vanguard pulls ahead, sometimes Fidelity does either way. On $100,000, that gap can still mean real money. Here's the shortcut. The lowest fee isn't the whole story. A fund that gets cash back into the market faster and avoids extra trading costs can still beat a cheaper fund. Simple, smart routines can outweigh a tiny fee difference. So where does it lean? Over long stretches, Vanguard's VFIAX often has a small edge. It closely matches the index and keeps reinvesting on schedule. On $100,000 over 30 years, that can add up to low six figures more under typical returns. Not a promise, just how small advantages compound over time. Mistakes to avoid: chasing last year's winner, that's noise. Ignoring fees when funds are the same. If tracking ties, the cheaper wins. Letting dividends sit in cash, that is lost return. My approach: one S&P 500 core, auto reinvest on, paperless on to avoid fees. I consolidate to one fund. Fewer clicks, fewer chances to mess it up. Here's a quick win. If you own both FXAIX and VFIAX, choose one and move everything into it. Turn on reinvest dividends, so payouts buy more shares automatically. Your future self cares about growth, not brand names. Now let's ask ourselves, what happens if you buy a fund that owns almost every US stock, not just the top 500? Let's zoom out to the whole market. One fund that owns big companies, medium ones, and small ones. Everything in one place. It's like buying the whole grocery store instead of guessing which aisle has the best deals. That usually makes the ride smoother. You also get small company growth without doing extra work. What we're comparing: Fidelity's FSKAX at 0.015% versus Vanguard's VTSAX at 0.04%. Both funds hold thousands of US stocks. You'll see the same big names: Apple, Microsoft, plus lots of smaller companies. Dividends are about 1% a year, and you can set them to automatically buy more shares. On paper, these funds look almost the same. Where they can differ: how closely they match the whole market list, and how quickly they put dividend money back to work. Some funds buy every stock on the list. Others buy most of them to save on trading. Some reinvest dividends a bit sooner. Think of it like planting seeds right away instead of waiting. Over many years, those small choices can change your final balance. The setup: start with $100,000, turn on dividend reinvestment, hold for 30 years, and don't trade. Over time, it's common to see a small total gap, about 1 to 3%. Even that small gap can mean thousands to tens of thousands of dollars on a six-figure investment. Common mistake: thinking the lowest fee always wins. How the fund is run day to day can wipe out a tiny fee edge. If a fund trades less, keeps less cash sitting idle, and handles payouts smoothly, it keeps more of your money invested. Small wins, repeated for years, really add up, people. So which way does it lean? Over long stretches, Vanguard's VTSAX often has a slight edge, even with the higher fee. If markets act like they have, a 1 to 3% total difference over decades on $100,000 can still mean tens of thousands of dollars. Mistakes to avoid: treating total market like a magic fix. Process still matters. Mixing S&P 500 and total market at random, then tinkering. Pick one clean core and stay disciplined. Another is letting dividends sit in cash. That is a leak. How I use it: when I want small caps baked in, I pick one total market fund. Auto reinvest on, paperless on, contributions on autopilot. Fewer parts means fewer bad choices when markets shake. Quick win: if you combined an S&P 500 fund with a separate small company fund, you can make it easier. One total market fund already includes both big and small companies and is enough for most people. Now smash that like button if you understand this and want growth with fewer ups and downs, because we're about to talk about balanced funds. Balanced funds keep things simple. About 60% in stocks for growth and 40% in bonds for stability. Fewer moving parts. Smaller freakouts during big drops. More time invested, which is how compounding helps you. Here's the matchup: Fidelity's FBALX is an actively managed fund with about 0.51% in yearly fees. Vanguard's VBIAX is an index fund with about 0.07 to 0.15% in yearly fees. Both aim for the same mix, 60% US stocks, 40% bonds. FBALX has managers picking and trading. VBIAX just tracks the market and keeps costs low. Why it matters? Higher fees mean less money compounding for you. 0.5% sounds tiny, but over 20 to 30 years, it takes a big bite. Extra trading adds more hidden costs, so the drag gets worse. An index fund with lower fees simply keeps more of your gains working for you each year. Think of it this way. If two funds earn the same before fees, the low-fee fund lets more of each year's growth stay in your account, so next year you're compounding on a bigger base. The setup is simple. Put in $100,000, turn on dividend and interest reinvestment, hold for 30 years, and don't touch it. If the active fund doesn't earn more than its higher fees and extra trading costs, it falls behind. Over long periods, VBIX, the low-fee index option, often finishes ahead of higher-cost funds. Quick reality check. Balanced doesn't mean can't lose money. When interest rates go up, bond prices can drop. Stocks can also fall quickly. The benefit is this. Lower fees and regular rebalancing help you keep more of whatever the market gives you. You're not paying extra for manager bets that may not work. Mistakes to avoid. A balanced fund is not a savings account. Its value can go down. Don't confuse yearly numbers with monthly payments. Most figures shown are yearly totals. Bonds can lose value when interest rates go up. Know this before you buy. In dollars, over 30 years, VBIX often finishes with a lot more money than FBALX. Start with $100,000 and the gap can grow big. Why? Higher fees in FBALX quietly eat into your growth every single year. Here's when. When I use my VBIAX, when I want a set it and ignore it core, especially in retirement accounts, I avoid higher cost funds unless I have no other choice. If a 60-40 mix fits your comfort level, VBIAX is a simple, low-maintenance option. Quick win. If your investments feel messy, make them simple. Pick one low-cost balanced index fund that's 60% stocks and 40% bonds. Turn on automatic deposits and reinvest dividends so new money and payouts to buy more shares for you. If you'd rather use separate stock and bond funds, just check once a year and move money to get back to 60-40. Pattern break. Want growth outside the US? Let's visit emerging markets. Now we're looking at a bumpier ride. Emerging markets means faster growing countries like India and Brazil. Prices can jump more from week to week. The upside, more growth and a portfolio that isn't only tied to the US. The trade-off, bigger drops when things get rough. The matchup, Fidelity's FPADX, 0.08% fee, versus Vanguard's Admiral Class Emerging Markets Index Fund. Both spread your money across many EM countries. They often pay a bit over 2% in dividends. Expect more movement from currency changes, government news, and index updates. These can move prices quickly. Here's a key point. In emerging markets, small details matter more. When an index changes its list of countries or companies, funds must adjust. How smoothly they do it can help or hurt results. Reinvesting dividends quickly keeps more of your money working. And some funds buy every stock in the index while others buy a sample to save on trading. Buying a sample can be cheaper, but matching the index can be tighter. Because prices swing more, these small differences can add up over time. The setup is the same. Invest $100,000, reinvest dividends, hold for 30 years, and don't tinker. Results can vary a lot. Recently, Fidelity's FPADX has been ahead. Its slightly lower fee and efficient operations can help it keep a little more during market upswings. In some models, FPADX finishes more than $200,000 ahead after 3 decades. Not a guarantee, just an example of how big market moves can magnify small advantages. Mistakes to avoid. Putting in too much after a big jump. EM can rise fast and fall fast. Ignoring how the index changes. If the index adds or removes countries, then remember that means what you own changes. Skipping rebalancing. Set a maximum percent for EM and check on a schedule to keep it there. How I handle it. I keep EM as a small piece of my portfolio and adjust it on a set schedule, not based on emotions. This way, you get the upside without panic driving decisions. Quick win. If EM makes you nervous, make it small enough that you could sit through a 40 to 50% drop without selling. If that means 5% of your portfolio, that's fine. Consistency wins. Let's sum it up in plain English. Fidelity is cheaper on fees and often does better in emerging markets. Vanguard usually wins in the core funds most people use. S&P 500, total market, and balanced. If you add those differences together, Vanguard could come out ahead by about $1.8 million on a $100,000 investment over 30 years. That's an example based on past trends, not a guarantee. Assumptions we used. All payouts were put back to work right away, dividends reinvested. Fees stayed the same as today. Markets grew roughly like they have over long periods. Money was in retirement accounts, IRA/401ks, so no yearly taxes. No delays or mistakes, no cash sitting idle, no pulling money out. If you change the starting numbers, your final results will change too. Try this quick test. Add or subtract 1% from the growth rate. Most of the time, the winner doesn't change for the S&P 500 total market and balanced funds because fees and tracking stay the same. The gap may get bigger or smaller, but the order often holds. Emerging markets is the exception. It can flip. Tax note. In a normal, taxable account, lots of trading and bigger dividends can raise your yearly tax bill. Broad S&P 500 and total market index funds usually create fewer taxes than funds that pay higher dividends or trade more. In IRAs and 401ks, you don't owe taxes each year, so taxes matter less, and automation, auto-invest, auto-reinvest works even better. Here are some actionable mixes for you guys. Stocks only. Pick just one core fund, either an S&P 500 fund or a total market fund. Both are enough on their own. Balanced core. Choose 160% stocks/40% bonds. Index fund, for example, VBIAX, for smoother ups and downs. Emerging markets. Keep it small, like 5% to 10%. Set a max and rebalance on a schedule. My rule set? Simple. Put costs first, lower fees. Then check tracking, stays close to the index. Then protect behavior, fewer funds, less tinkering. Automate everything. Automatic contributions, automatic dividend reinvestment, and a once-a-year rebalance. Small edges repeated for years create big results. I get it. You're working that regular job, counting down the hours, dreaming about the day when you don't have to show up anymore. You want freedom. You want choices. And I'm telling you right now, you can absolutely get there. But here's the real talk. It takes time. This is a slow and steady race, not a quick dash to the finish line. Remember that $1.8 million difference we just talked about? That didn't magically appear in 1 year or even 5 years. It happened because someone picked the right fund, put their money in, and then, and this is the important part, they left it alone. They didn't mess with it. They just let time do the work while they went on living their life. Everything worth having takes time. Your investment account won't double next month. The stock market will go down sometimes, maybe way down. Your friends will talk about making fast money on some random cryptocurrency. You'll feel like you should be doing something, anything. Here's my advice, don't. Sometimes the smartest move is to do absolutely nothing and just wait. But you can't just wait and hope for the best. You need a real plan written down somewhere, because if you don't have a plan, you're basically planning to mess this up tonight. Grab a pen and paper. Yes, actual paper, not your phone, and write down what you want. How much money do you need to quit your job? When do you want that to happen? What does your free life look like? Traveling the world, starting your own thing, never setting an alarm again. Write it all down and make it feel real. Then take it one step further. Make a vision board. I know. It sounds silly, but stick with me. Cut out pictures or print images of what you're working toward. Put them somewhere you'll see every single day. When the market drops and you're scared, you'll look at those pictures and remember exactly why you started investing. You'll remember what you're building toward. Stay focused. Stay positive. I don't mean ignoring problems or pretending everything's perfect. I mean sticking to your plan, even when everyone around you is freaking out or showing off their gains. These two things, staying focused and keeping a good attitude, will help you keep your money invested. And keeping your money invested is the whole game. If you pull your money out when things look bad, you lose. If you stay put, history shows you'll win. Keep learning about money and investing, just like you're doing by watching this video right now. Subscribe to Money Introduction so you keep learning and stay up to date on how to take care of your investments. Because here's what most people don't realize. Taking care of what you've already invested is just as important as putting the money in to begin with. Starting is step 1. Staying invested is step 2. But checking in, making small adjustments, and protecting your money, that's how you actually win. You can do this. Write your plan, make your vision board, don't give up. See you next time.